You need to see what's happening right now. Because if you're holding silver or thinking about it, what's showing up on brokerage statements this week is either going to make you very nervous or very excited, depending on how you understand what you're looking at. I'm talking about a specific line item that's appearing on statements from major brokerages. A notation. A classification change. And it's causing absolute chaos in silver stacking communities because most people don't understand what it means or why it's happening now. Let me show you exactly what this is about. The line reads something like this. Position reclassified. Physical delivery restrictions apply. Or sometimes, settlement terms modified. Cash equivalent only. The exact wording varies by broker, but the message is the same. Your silver position, the one you thought gave you claim to actual metal, has been quietly redesignated. Now, here's where this gets interesting. This isn't affecting everyone. It's not random. There's a very specific pattern to whose accounts are getting these notifications. And understanding that pattern tells you everything you need to know about what's really happening in the silver market right now. The accounts getting flagged are the ones holding silver through ETFs, through certain futures contracts, through allocated pool accounts at major institutions. Basically, any silver position that exists as a paper claim rather than physical metal in your possession. And the reason these are being reclassified right now, in early 2025, has everything to do with a problem that's been building for years, but is finally reaching a breaking point. The problem is this. There's not enough silver to go around. I know that sounds dramatic. You hear about shortages all the time. But this is different. This is structural. This is mathematical. And the institutions know it, which is why they're changing the terms right now, before the situation becomes impossible to manage. Let me walk you through the numbers, because this is where it gets really interesting. Global silver production in 2024 was approximately 830 million ounces. That's from mining, from recycling, from every source combined. Now, industrial demand alone consumed about 650 million ounces. Solar panels, electronics, medical applications, electric vehicles. These aren't optional uses. These are critical industrial processes that cannot function without silver. That leaves 180 million ounces for everything else. Investment demand, jewelry, silverware, coinage. Except investment demand in 2024 was running at about 250 million ounces. You see the problem. The math doesn't work. There's a deficit of 70 million ounces that has to come from somewhere. Where does it come from? Existing stockpiles, above-ground inventory, the silver that's already been mined and is sitting in vaults, in ETF holdings, in allocated accounts. That silver is being drawn down to meet the shortfall between production and demand. Now here's the critical part. Those stockpiles aren't infinite, and they're not all available. A huge portion of above-ground silver is in the form of jewelry, silverware, industrial products. It's not coming back to market unless prices go dramatically higher. The available inventory, the silver that can actually be mobilized to meet demand, is much smaller than most people realize. The COMEX, the major commodities exchange where silver futures trade, reported about 280 million ounces in registered inventory as of January 2025. Registered means it's available for delivery against futures contracts. That sounds like a lot, until you realize that open interest in silver futures represents claims on over 900 million ounces. There are more than 3 times as many paper claims as there is physical silver available to deliver. This is why your broker is sending you that notification. They're preparing for a scenario where they cannot deliver physical silver, even if you have a contract that says they should. They're changing the terms now, while they still can, before the situation forces their hand. And it's not just the COMEX. The London Bullion Market Association, the LBMA, which handles the majority of global silver trading, has been seeing similar stress. In late 2024, there were reports of delayed deliveries, of premiums spiking for physical metal even as paper prices stayed relatively stable. That's the signature of a market where paper and physical are starting to disconnect. You want to know what this reminds me of? 1980. Not the price spike, not yet, but the setup. The conditions that made that spike possible. In 1980, silver went from about $8 an ounce to $50 in a matter of months. Everyone remembers the Hunt brothers, the famous attempt to corner the silver market. But what most people forget is why their strategy almost worked. It worked because there was already a supply deficit. Industrial demand was growing. Investment demand was surging because of inflation fears, and the available supply was concentrated in relatively few hands. The Hunt brothers didn't create the shortage. They exploited a shortage that already existed. And when they started taking delivery of physical silver, demanding actual metal instead of accepting cash settlement, the system couldn't handle it. Prices exploded because there wasn't enough physical silver to meet all the claims. We're seeing the same setup now. Industrial demand is higher than it's ever been and growing. Solar panel production alone is projected to consume 20% more silver in 2025 than it did in 2024. Electric vehicles, 5G infrastructure, medical devices. Every major technological trend is silver intensive. Investment demand is surging because people are worried about inflation, about currency debasement, about the stability of the financial system. Silver Eagle sales from the U.S. Mint hit record levels in 2024. Retail demand for physical silver is the highest it's been since 2011, and the available supply is concentrated. A handful of ETFs control massive amounts of silver. A few major banks dominate the futures market. The system is set up exactly like it was in 1980, where a relatively small shift in behavior, a move from paper to physical, could trigger a massive price spike. That's what these statement notifications are really about. The institutions are seeing the same data you and I are seeing. They're watching the inventory drawdowns. They're seeing the supply deficit. They're calculating the risk that a significant number of investors might decide they want physical delivery instead of paper claims. And they're protecting themselves. By reclassifying positions now, by adding restrictions on physical delivery, they're making sure they won't be forced into a situation where they have to deliver silver they don't have. Now, if you're sitting on retirement accounts, if you've got $100,000 or more in traditional investments, this is something you need to think about. Because what's happening in silver is part of a broader shift in how people are thinking about wealth preservation. I put together a free guide on how gold IRAs work, how you can get physical precious metals into your retirement account without tax penalties. It's in the description. Worth checking out if you're concerned about the stability of paper assets. But back to what's happening right now with these statements, because the implications go beyond just silver. What we're seeing is a stress test of the entire precious metals market structure, and it's revealing something that a lot of people suspected but couldn't prove. The paper market is much larger than the physical market can support. Think about what that means. For decades, the price of silver has been determined primarily by trading in futures contracts, in ETFs, in allocated accounts. Paper silver. The vast majority of silver trading never involves physical metal changing hands. It's just contracts being bought and sold, claims being transferred. That system works fine as long as everyone is content to hold paper claims, as long as nobody asks for actual delivery. But the moment a significant percentage of holders decide they want physical metal, the system breaks down, because there isn't enough physical silver to satisfy all the paper claims. This is what happened in March 2020, briefly, during the COVID panic. Premiums on physical silver spiked to $6, $7, $8 over spot price. You could sell a silver futures contract for $18 and simultaneously be unable to buy a physical silver coin for less than $25. The paper price and the physical price disconnected because there was a surge in demand for physical metal and the supply chains couldn't handle it. That was a temporary disruption. Supply chains recovered. Premiums came back down. But it showed what could happen if the disconnect became permanent. If physical demand consistently exceeded available supply. That's the scenario these broker notifications are preparing for. A world where paper silver and physical silver are fundamentally different assets, with different prices. Where your ETF shares might be worth $28 according to the spot price, but actual silver coins are trading for $35 or $40 because there's a shortage of physical metal. The institutions are getting ahead of this. They're making sure their legal obligations are clear. If you hold paper silver, you're entitled to the cash value, not necessarily the physical metal. They're putting that in writing now, before it becomes a crisis. And you can see this playing out in other ways too. Premiums on physical silver have been elevated for months, not as extreme as March 2020, but consistently higher than historical norms. Dealers are reporting longer wait times for certain products. Mints are struggling to keep up with demand. The Royal Canadian Mint, one of the largest silver coin producers in the world, announced production delays in late 2024. The US Mint has had to ration Silver Eagles multiple times. These aren't temporary supply chain issues. This is sustained demand exceeding production capacity. And here's what makes this really interesting. This is happening while silver prices are still relatively low by historical standards. Silver is trading around $28, $29 as I'm recording this. That's well below the 2011 high of $49. It's nowhere near the inflation-adjusted 1980 high, which would be over $150 in today's money. So we have record industrial demand, surging investment demand, declining available inventory, and prices that are still historically cheap. That's not a sustainable combination. Something has to give. Either demand has to fall, which seems unlikely given the industrial trends, or supply has to increase dramatically, which is difficult because silver is primarily a byproduct of other mining operations. You can't just open a new silver mine quickly. Or prices have to rise significantly to ration demand and incentivize more supply. The smart money is betting on that third option, and they're positioning accordingly. Look at what the big institutions are doing, not what they're saying, what they're doing. JP Morgan, which was famously short silver for years, has reportedly accumulated one of the largest physical silver positions in the world. They're not holding paper claims. They're holding actual metal in vaults. Why would they do that if they thought paper claims were just as good? Why would they go through the expense and logistics of storing physical metal if they believed the paper market was stable and reliable? They're doing it because they know what's coming. They've seen the supply data. They've run the numbers. They know that at some point, the paper market and the physical market are going to diverge. And when that happens, you want to be holding physical. This is the same pattern we saw before the 2008 financial crisis. The big banks knew there was a problem with mortgage-backed securities. They knew the housing market was over-leveraged. So what did they do? They bought credit default swaps. They protected themselves. They positioned for the crisis while still publicly maintaining that everything was fine. We're seeing the same thing now in silver. Public statements are calm. Official positions are that the market is functioning normally. But behind the scenes, the big players are accumulating physical metal and changing contract terms to limit their exposure to delivery obligations. That's what your statement notification is really telling you. It's telling you that the institution holding your silver position is worried about their ability to deliver physical metal if you ask for it. So they're changing the rules now, while they still can, to make sure they're not legally obligated to do something they might not be able to do. Now, does this mean silver prices are about to explode tomorrow? Not necessarily. Markets can stay irrational longer than you can stay solvent, as the saying goes. The paper market can continue to function even with these underlying stresses. Prices can stay suppressed through futures market manipulation, through ETF creation, through all the mechanisms that have kept silver prices relatively low for years. But what it does mean is that the risk of a sudden, dramatic price spike is higher than it's been in decades. Because all the conditions are in place. The supply deficit, the inventory drawdown, the concentration of physical holdings, the growing awareness among investors that paper claims might not be as good as physical metal. All it takes is a catalyst. A major industrial buyer deciding they need to secure long-term supply. A geopolitical event that disrupts mining production. A loss of confidence in the financial system that drives a surge in precious metals demand. Any of these could trigger a rush for physical silver that the market cannot accommodate. And when that happens, when the paper market and the physical market finally disconnect for real, the price movements are going to be violent. We're not talking about silver going from $28 to $35. We're talking about moves like 1980, where prices doubled and tripled in a matter of weeks. This is why the statement notifications matter. They're a warning sign. They're telling you that the institutions are preparing for a scenario where they cannot meet physical delivery obligations. And if they're preparing for that scenario, you should be thinking about it too. What does that mean practically? It means if you want to own silver, you need to think carefully about how you own it. Paper claims, ETF shares, futures contracts. These might give you exposure to silver prices, but they don't give you the security of physical possession. And in a crisis scenario, that difference could be enormous. Physical silver in your possession cannot be reclassified. It cannot be cash settled against your will. It cannot be subject to delivery restrictions or contract modifications. It's yours. That's the whole point. This is why we're seeing such strong demand for physical silver, even as paper prices stay relatively stable. Informed investors understand the difference. They're looking at the same data the institutions are looking at. They're seeing the supply deficit, the inventory drawdowns, the stress in the physical market. And they're acting accordingly. The premiums you're paying for physical silver right now, the $3, $4, $5 over spot price, that's not just dealer markup. That's the market pricing in the risk that paper and physical are going to diverge. That's the market saying physical silver is more valuable than paper silver, because physical silver is scarce and paper silver is abundant. And those premiums are likely to widen. As more people become aware of what's happening, as more investors decide they want physical metal instead of paper claims, the demand for physical is going to increase, while the available supply continues to decline. That's going to push premiums higher, which will eventually pull spot prices higher as the paper market is forced to acknowledge the reality of the physical market. We're already seeing this in other precious metals: platinum, palladium, even gold to some extent. The premiums on physical metal have been elevated for months. The spread between paper prices and physical prices has been wider than historical norms. The market is telling you something. It's telling you that physical precious metals are undervalued relative to paper claims. It's telling you that the supply situation is tighter than official numbers suggest. It's telling you that the risk of a supply crisis is real and growing. Your broker's statement notification is part of that story. It's one more piece of evidence that the institutions are worried about their ability to deliver physical metal. One more sign that the paper market is under stress. One more reason to think carefully about how you're positioned in precious metals. Because here's the thing. Once this situation resolves, once the paper market and the physical market either reconnect or permanently diverge, the opportunity will be gone. Right now, you can still buy physical silver at prices that are only slightly above paper prices. You can still convert paper positions to physical metal, though it's getting harder and more expensive. But if we get a real supply crisis, if we get a situation where physical silver is genuinely unavailable at any reasonable price, that window closes. You'll be stuck with whatever position you have. If you're holding paper claims, you'll get cash settled at whatever the paper price is, even if physical metal is trading at a massive premium. If you're holding physical metal, you'll have an asset that's suddenly much more valuable than the market previously recognized. This is the choice that's in front of silver investors right now. And the statement notifications are making that choice explicit. Your broker is telling you, in writing, that your paper claim might not be convertible to physical metal. They're giving you the information you need to make an informed decision. The question is, what are you going to do with that information? Because the institutions have already made their decision. They're accumulating physical metal. They're limiting their delivery obligations. They're preparing for a scenario where paper and physical diverge. They're not waiting to see what happens. They're positioning now, while they still can. The smart individual investors are doing the same thing. They're looking at the supply data. They're watching the inventory levels. They're seeing the premiums on physical metal. And they're making the decision to hold physical rather than paper, even if it costs a bit more, even if it's less convenient, because they understand what's at stake. This isn't about timing the market perfectly. This isn't about trying to buy at the absolute bottom and sell at the absolute top. This is about understanding a fundamental shift that's happening in the precious metals market and positioning yourself accordingly. The paper market has been the dominant force in precious metals pricing for decades, but that's changing. The physical market is asserting itself. Supply constraints are becoming binding. The difference between owning a claim on silver and owning actual silver is becoming material. Your statement notification is documenting that change. It's evidence that we're in the middle of a transition from a paper-dominated market to a physical-dominated market. And transitions like this create opportunities for people who understand what's happening and act accordingly. So when you see that line on your statement, that notification about reclassification or delivery restrictions, don't panic. But don't ignore it either. Understand what it's telling you. Understand that the institution holding your silver position is worried about their ability to deliver physical metal. Understand that this is part of a broader pattern of stress in the physical silver market. And then make your decision. Do you want to hold paper claims that might be cash settled in a crisis? Or do you want to hold physical metal that's yours regardless of what happens in the financial system? The institutions have made their choice. They're holding physical. They're limiting their paper obligations. They're preparing for a world where paper and physical are fundamentally different assets. The question is, are you going to follow their lead? Or are you going to trust that the paper market will continue to function normally, despite all the evidence that it's under stress? That's what those statement notifications are really asking you. And how you answer that question is going to determine whether you benefit from what's coming or get caught on the wrong side of a historic market shift.